On the 5th of December, the European Union will announce the next in its series of measures against the problems of international tax avoidance and tax evasion. In this case, what they're bringing forward is a blacklist, a list of what they're calling non-cooperative jurisdictions, particularly with respect to corporate taxation. Now, that list is based on 3 criteria, which they've published some details of already, and therefore we've been able to reconstruct what we think that list will look like. We've found 41 jurisdictions that don't meet the criteria. Now, we know from leaks to the Financial Times that the European Union actually gave advance warning to 53 jurisdictions that they could be in line to be listed. So it's possible that the EU have actually interpreted this more strictly. But equally, they may, on the basis of some private information that nobody can see, decide not to list some or all of those 53. The 3 criteria being used are as follows. First is tax transparency, and that's really a measure of whether countries have signed up to the OECD Common Reporting Standards for the automatic exchange of tax information. That's basically aimed at shutting down the kind of bank secrecy where you could have a foreign account at a bank and be confident that it wouldn't be declared to your tax authority. The second is fair taxation, and that's a bit more complex. I'll come back to that in a second. The third one is about taking measures under the Base Erosion and Profit Shifting Initiative of the OECD. And again, that's really about whether you've signed up to meet the minimum standards of the OECD BEPS process. Now, that second criteria, fair taxation, is the slightly trickier one. And there, it's not at all clear from the criteria quite how they can be interpreted. And that's a weakness of the criteria. They need to be objectively verifiable. One of the other weaknesses of the EU approach is that they decided from the outset that they wouldn't consider themselves, they wouldn't apply the criteria to European Union member states. As we have no such limitation, that's exactly what we've done. And we find that as many as 6 member states could be put on the blacklist under those criteria. That's Cyprus, Ireland, Luxembourg, Malta, the Netherlands, and the United Kingdom. Now, in some sense, these are the usual suspects. You kind of expect to see, in particular, Ireland, the Netherlands, and Luxembourg there as the biggest profit-shifting jurisdictions. The UK is an interesting one, though, because as of 2019, if Brexit goes ahead, then the UK will indeed be in a position of being a non-member state and therefore subject to European Union blacklisting. Time will tell whether that's the way things go. The Tax Justice Network is calling for an international convention to be negotiated not only by the Members Club of the G20 or the Members Club of the OECD or the Members Club of the European Union, but globally, ideally within the United Nations, certainly including the G77 group of developing countries, so that all states have ownership of the criteria and all can move to a position where they're accepting, agreeing and adhering to minimum international standards of financial transparency. Standards that would include the automatic exchange of tax information on a truly global multilateral basis, public registers of the beneficial ownership for companies, trusts and foundations, and public country-by-country reporting by multinationals so that everyone can see the extent to which profit shifting is being procured by certain states like Luxembourg and the Netherlands within the European Union, and a number of others like Bermuda and the Cayman Islands and Switzerland, Singapore outside it. Only when we have that transparency and a set of standards that everyone is adhering to, including the United States and the European Union's own members, can we expect to see the level of progress that we need, and in a way that makes sure the benefits accrue to lower income countries as well as the most powerful states.